I know you, every one of you have busy lives and many things going on, so I appreciate the time that you're sharing with me tonight, and I'm going to do my best to make sure that you don't waste that time and that you actually learn something hopefully applicable to the markets. So let me begin by saying thank you very much for joining me tonight. I really do appreciate it. And again, I hope I can show you something this evening that you haven't ever seen before or seen in a book. So that's going to be my goal for this evening. So again, welcome to tonight's live webinar on moving averages. Again, my name is Jeffrey Kennedy, and I'm the editor of Futures Junctures. The first thing I would like to do is basically give you a brief outline of tonight's progress, or the plan I intend to follow. And it's going to be fairly, I don't think it's going to be brief. I suspect tonight's webinar should last about an hour, hour and a half. For those of you who have joined me before on other webinars, know that I have a very bad time of continuing beyond my time limit, so I'll do what I can to keep things within a proper parameter. But what we're going to basically be doing initially is following the outline that you see in front of you, which is what is a moving average, different types of moving averages, popular moving averages in the wave principle, my very own favorite moving average trade setup, and then I'm going to show you something kind of special that I worked on a number of years ago that is a really neat tool, and I think it's unique, and I hope you enjoy that. And that'll be the last section in tonight's webinar. So let's go ahead and begin and answer the basic question: what is a moving average? And very simply, it's a moving average is the average value of data over a specified period of time. Now, what makes a moving average exciting is that you can have that data point being the close, it can be the open, the high, it can be the midpoint of the range, it can be a volume, and more also too, it's very versatile in that it can be a 3-period moving average or a 5-period moving average. It can be at any time frame that you so desire. So what's interesting and again exciting about the moving average, and why it's, I think, a very popular technical tool or indicator, is that it's so it allows you to be very versatile with regard to what value you put in and also what time period you examine. Now, what are some of the most common types of moving averages? Well, there's a lot of different types of moving averages, many different calculations. You have the simple moving average, which I'm sure everyone is familiar with, the exponential moving average, the weighted moving average, something called a smoothed moving average, centered moving average, an adaptive moving average, and a triangular moving average. These are, and I'm sure this is an incomplete list because I'm sure there's different other moving averages out there, but these tend to be the most popular, and specifically the simple moving average, the exponential moving average, and the weighted moving average are really what I would consider the big three. So for tonight's webinar, I'm probably going to be spending most of my time examining these three up here: simple, exponential, and weighted, and primarily simple. And the reason why is because this chart right here shows you, and it's color-coded, the red line here represents a 10-period weighted moving average, okay? And then the green line represents a 10-period exponential moving average. The blue line is a 10-period simple moving average. And again, I'm not going to spend time on discussing the math and the formula behind calculating these moving averages, except to simply say that the exponential moving average and the weighted moving average, the way they differ from a simple moving average is that they put more weight or more value on the front numbers. For example, if you have a 10-period moving average, you look at each period, you assign the same weight to each period. With exponential and weighted moving averages, you tend to put more weight on the most recent occurrence of data. And as you can see from this chart here, this one slide, the variation is noticeable, but not enough to really make, I think, a big difference with regard to analysis. I've worked with basically all types of moving averages over the years, and I've come to basically rely mostly on the simple moving average, mainly because it's simple. I like things simple because simple things tend to work. So we're going to be spending probably most of the night examining the 10-period weighted moving average. Okay, now whenever it comes to moving averages with regard to analysis, most people are probably going to encounter or be familiar with its most simplistic approach, and that would simply be a dual moving average crossover system, which is what you have here. Now the settings on this screen is a 5-period simple moving average, and that's going to be the blue line, and I'll make that blue, and a 10-period simple moving average. This is probably the most common application of moving averages, and initially, whenever you become interested in analysis and technical studies, you'll see a chart like this, and you'll see some moves. And primarily what I'm referring to is this kind of a price move right here. Let me re-identify that. This move right here and this move right here. And you kind of look at, this is a chart of corn, and you see the crossover at the top here, which is indicated by the red arrow to the downside. And that's simply indicating that the 5-period simple moving average crossed below the 10-period simple moving average. And at first look, you're thinking, wow, what a great trade. You know, it gave you a signal right here, and you would have been short, and you would have made lots of money. Well, one thing people don't realize is the type of indicator a moving average is. A moving average is a trend following indicator. It always lags the market. And whenever the market is trending, like for example during this period and again during this period, moving averages tend to work very, very nicely. The problem or the trouble comes from whenever you enter a period of market congestion, i.e. when there is no trend. Being a moving average, again, it is a momentum indicator, it is a trend following indicator, and whenever a market is trending, like what we're currently seeing recently in grains or currencies, they work beautifully. They're very exciting, and that's what kind of makes people really enjoy working with the moving averages. The frustrating part, though, is whenever you enter a sideways market or a market where there's no trend, and then that's when you get a lot of false signals, as I've identified right here. Now, I've spent a lot of time working with moving average crossover systems. Actually, I've spent years back-testing different types of moving averages, exponential, weighted, smoothed, simple. I've looked at numerous time frames, numerous markets. I've done extensive back-testing, probably spent about 2 or 3 years actually taking apart moving averages and trying to figure out what would be the best way to apply them from an analytical perspective and, more importantly, from a trading perspective. And the one thing I've learned, and you may want to write this down, is that there is no magic moving average. There is no magic moving average setting, and what I'm referring to is that there's not one specific period that works across all markets and all time frames. And that's probably the one thing I learned the hard way after examining moving averages for literally a number of years. If you're interested in actually optimizing a market according to a specific moving average or a moving average crossover, then what I would recommend is that you do a number of things. One, you need to identify the market, specific market, i.e., for example, corn. And then you need to identify your moving average parameters. And then what you'll need to do is actually do something called out-of-sample data testing. What that refers to is you'll simply examine one period of time utilizing those moving averages, say, for example, 5 and 10, and then you'll look at another period of time and use the same settings during this period of time as well. And what you'll see a lot of times is different results if you're going to be back testing moving average trading system. You can actually optimize a dual moving average crossover system for a specific time frame and for a specific market. But with regard to a time frame or a specific market, with regard to one set moving average setting that works across all markets and all time frames, I haven't found one. Now, one thing that I did learn in my work with moving averages is one way you can actually overcome this whipsaw here with regard to with regard to a dual moving average crossover system is employ what I call a moving average price channel system. And it's not as complicated as it sounds, and this is what a moving average price channel system. This moving average right here, the one I'm pointing to, that is a 20 period, and let me put that on there. That is a 20 period simple moving average of the high. The lower black line is a 20 period simple moving average of the low. This is your moving average price channel. Now notice there's another line here which is a blue line. And I forgot the setting up for that, but no, that is a 5-period moving average right there. And again, it's a 5-period simple moving average, and it's going to be of the close. Now what I'd like to do is just kind of show you back and forth again. Here was the dual moving average crossover. And again, this is the main problem with moving averages and a moving average crossover system, is that it works well in trending markets. And again, let me identify those. Trending market was here, a trending market was here, and a trending market was here. But in markets or periods of time where there's no trend, moving average systems do not work well. One way to overcome this problem is to employ what I call a moving average price channel. The settings that you see in front of you, again, the blue line here is a 5-period simple moving average of the close, and the two black lines are 20-period simple moving averages of the high and the low. So what that does is it creates a price channel. Now, the arrows that you see right here and right here, those are my, for lack of a better term, those are my buy and sell signals with regard to this system. And the way they occur is whenever the 5-period simple moving average of the close, or the blue line, crosses above the upper boundary line of our price channel, that's considered a buy. Whenever the blue line crosses below the lower line, or the 20-period simple moving average of the low, that's considered a sell. So this is one way you can actually try to overcome the problem with moving averages, because again, during a non-trending market, the moving average will give you a lot of whipsaws. By utilizing a price channel here, as you see here, it cuts down on the number of whipsaws. And notice that since the move up began, you had nothing but buy signals to the upside, and a very nice move to the downside here, signaling the short that we recently saw in corn. So those are two ways you can actually apply, or two popular ways to actually apply moving averages. Again, you can utilize a dual moving average crossover system, which is the most popular. And again, there's no magic setting. There's no magic number. For illustrative purposes only, I've utilized the numbers 5 and 10 just to kind of give you a visual feel. Again, no, there's no magic number. It's whatever you feel comfortable with. And again, you can optimize these settings, but I would encourage you to basically stick to a specific market and a specific time frame, because what will work on, say, for example, the Canadian dollar on a daily level oftentimes will not be as effective on the Canadian dollar on a weekly level, and vice versa. Okay, I have a lot of charts here, so give me just a quick moment to get organized. Okay, now one way we can work with the moving average systems, or one way I explored when I was working with the moving average systems was to actually combine these two approaches. Combine the crossover technique with the price channel technique. Now what you have here is, again, the price channel. This is the price channel system. Now the green arrows right here identify when the blue line crosses the 20-period moving average of the higher line, which is actually a 20-period simple moving average of the high, and the reds indicate a close below. The diamonds that you see right here, that's when the 5-period moving average crossed below the 10. So what this system is, it's basically two moving average systems combined in one. And the purpose of this is to give you a slow entry, as I've identified up here, by utilizing the moving average price channel system. That gives you a slow entry, but a quick exit. So this is one way you may want to explore. And let me just pull up a few charts to kind of show you this methodology. Here is a stock net logic, and here is one of our green arrows right here, and there's one of our red diamonds as far as a slow entry but a quick exit. And again, I do like this price channel. If I had to pick between a dual moving average crossover system versus a price channel system, I think I would tend to favor the price channel system because it gives me, it more easily identifies areas of support to expect reversals in trend. Notice how the market here, more importantly also the moving average, dipped into the price channel and then turned back up. This is an excellent indication of a counter trend move within a larger uptrending market, and the same thing occurred here as well. Also too, if you look to the downside within this sell-off here, you can see how prices pushed into the price channel, turned back down. Pushed into the price channel and then turned back down. This was actually a successful break, so what I would envision from a trading perspective, let's just assume that our price channel continues higher. If prices were to pull back into the channel and begin turning back up, I would consider this a buying opportunity for a move back to above this extreme right here. Okay. Now before I get too much farther, typically what I'd like to do is hold questions until the end of the presentation. But I know I have a lot of information going on right now, and it's very intricate information. So I would like to take just one or two questions for maybe about 5 minutes here on what I've covered thus far before I move on to some other aspects of how you can utilize moving averages most effectively. So if one or two of you have a few questions, go ahead and shoot me a quick line, and I'll answer them before I continue much farther into tonight's presentation. Okay, here's a good question. Is backtesting the only way to optimize for a given market / time frame? Answer for that is simply yes. I think the best way to begin, though, with regard to trying to identify optimal moving averages for a specific time frame and for a specific market, is to give it a visual inspection. Your eye can really see a lot of things that your mind actually misses. So if you work with, say, for example, I mentioned the Canadian dollar. If you worked with, say, the Canadian dollar on a daily time frame, you can utilize either the dual moving average crossover approach, which again is very, very popular, or you can utilize the price channel approach, which tends to be what I prefer. Utilize that on the daily Canadian dollar. I would recommend examining, say, going back at least 10, 15 years, examining those settings in, say, 5-year increments, and then that way you should be able to come up with a mean that actually works. What's very unfortunate with backtesting, or what many people do whenever they're trying to test a moving average crossover system. And the reason so many people tend to do that is because it's actually a very simple methodology to actually program. But with regard to the backtesting, what they'll do is they'll look at a period of time where a market was trending and look at the results, and they say, wow, I could have made $1 million examining price action just from here to here. But if you take this type of the results you achieve from one period, but don't check them or test them against a period of price action where it's very choppy and sloppy or very sideways or there's no trend, the results are going to be very, very different. Backtesting is very strenuous, very laborious. It really helps if you have a good program that'll help you do that. And I know many softwares out there have that. Genesis Navigator has that ability. TradeStation has that ability. But there's many platforms out there. Here's a very good question. Do most trading programs have the formulas for simple moving average of highs and lows? Will you give us the formulas at the end? Thanks. Okay, most platforms, charting platforms that you are aware of, and NinjaTrader is one, SuperCharts is one, Metastock is one, Trade Navigator by Genesis, and TradeStation. Most, if not all, of your charting platforms will have moving average capability. And simply to create a moving average channel like this, you would simply go in and change the setting from the moving average of a close to the moving average of a high. Let me just move over another slide here. This was the 5-10 moving average crossover system. And again, let me just reiterate, I love moving averages. They're fascinating to work with, especially when you look at markets or price action. For example, from this point to this point, you look at the results, buy, sell, buy, sell, buy, and it's just like, wait, hey, how can I lose money trading this? Well, after years of experience, what you begin to realize, it's these periods of time right here where your enthusiasm is greatly diminished because a lot of the buys and sell signals, as you can see, obviously failed. And again, this is why I prefer the price channel methodology, creating that price channel versus actually playing the straight dual crossover. But again, towards the end of the presentation, I'll actually show you the result of probably 2-3 years of my analysis with regard to moving averages, and something that I came up with that works well for me, and I hope it does for you. Okay. Here's an excellent question. Do you not find Fibonacci values in moving averages to be more reliable? The question is, do I find Fibonacci values reliable with regard to moving averages? And I believe the question is, let me create a new chart here. And that would simply be something along these lines. Let me clean my chart up real quick. Just give me a quick moment. The reason you're experiencing silence right now is because I'm not talking, so everything's okay with the audio. Okay, these are all simple moving averages. There are many fans of Fibonacci, and rightfully so. I find Fibonacci integral or very critically important tool with regard to analyzing financial markets. And that in itself is worth a good 2-hour webinar just on the importance of Fibonacci. But the question is, a lot of people like to utilize Fibonacci numbers when they create their moving averages. For example, 3, 5, 8, 13, and 21. And a lot of people really like to utilize these moving averages whenever they work. My answer to this is, I think, of course, Fibonacci has relevance with regard to financial markets, but if I were to design a specific moving average trading system for a specific market, I wouldn't want to limit myself to only Fibonacci numbers. I would like the market to actually point the numbers out which are relevant to that market. What you'll find is if you have an over-adherence to Fibonacci values with regard to different settings, say with stochastics or with oscillators or with moving averages, it really puts you in a box with regard to your thinking because it eliminates you opening your mind to a wider variety of numbers. So I would let the back testing or actually let your eye tell you what moving averages seem to be more reliable. For example, I do like the 5-period moving average quite a bit. I play with the 3 sometimes, but I've actually found a lot of value in a 4-period. It all depends on the market I'm looking at, and it all depends on the time frame. Again, there's not a single number, a single value, Fibonacci or otherwise, which is a magic number that works in all markets and all time frames. Even so, moving averages are a very, very important tool and can help you identify very viable trade setups. And what I'm referring to, again, would be like the best example would be with regard to this price channel methodology here. Whenever you see the blue line come up out of the price channel, dip back in, this is a straight buying opportunity. This is the 20-period, if you recall, the black line here is the 20-period moving average of the high. The lower band is the 20-period moving average of the low. And the blue line is a 5-period moving average of the close. Because these two moving averages have a longer duration, they're 20 periods, it's basically telling you that the trend is up. And this revisit into the moving average area or the zone right here is basically saying, hey, I'm a great buying opportunity right now, especially when you got this decisive close that you did on this day right here, the one I'm pointing to. So this is a very simple technique, and it's a great little technique and a great little tool. And again, I did not optimize these settings. This is just a 5-period moving average with a 20-period price channel moving average setting. And that was just with NetLogic. That was simply a stock. Here's another example of Corning, GLW. Notice how each time the market moves into the price channel, it offers a buying opportunity. And once you get a decisive break of that price channel, it clearly shows that the trend has turned to the downside. So we have a clear uptrend. And again, it's very similar to Elliott wave theory. You have impulse waves, which consist of 5 moves. And then you have your 3-wave correction. And I've talked about this in my futures junctures quite a bit with regard to what are the idealized Elliott wave setups. This is a buying opportunity in wave 2. This is a buying opportunity in wave 4. You have a selling opportunity at the top of wave 5, and another one here. Let me just put the labels on that real quick so you see what I'm referring to. So this moving average price channel methodology that I'm showing you here, I have seen about it. I have read about it. I have worked with it. I do prefer it much better than the dual crossover. But what this does, this channel allows you to do, again, is identify those counter trend moves within uptrending markets. And again, it's the revisit of the blue line into the 2 thin lines, which again are 20-period moving average of the high, 20-period moving average of the close. Now, let me see if there's any more indicator. Okay, is there an indicator that suggests a market is trending and not consolidating, or if a market is trending and or not trending? Excellent question. Probably the most popular indicator out there that talks about whether a market is trending or not trending is, I would probably say ADX. And if I recall correctly, that was a technical study developed by Wells Wilder. I've tried to understand ADX, and it may just be me and my ignorance, but I just don't get it. I don't grasp ADX. I do know some analysts who love it, but if you're patient with me, I will, toward the end of the presentation, show you a tool that I use that does just that. So hang with me. I have answered a few questions. Let me move on to the next section, and that's simply going to be, hold on here, I don't want to get too ahead of myself with my slide presentation happening. There's a few settings I do want to mention, and I'll be telling you with regard to their usage as well. Probably the most popular moving averages, I'm going to be going over these settings with you shortly, is the one in front of you right now. It is a 50-period simple moving average of the close and a 200-period simple moving average of the close. Whenever you're listening to CNBC, they may mention these moving averages. A lot of people follow these moving averages, especially on the daily level and especially with regard to the stock market, and you can see why. Here's an example of where the 200-period moving average provided resistance for that April-May move up in the Dow Jones. Currently, we're testing the 50-period moving average and seem to have reacted. As you can see here, the 50-period moving average provided support over here at this section. Hold on here. Let me make my pencil just a little bit thicker here. And also, so here was an example of where the 50-period moving average provided resistance. Here's where it provided support. Here's where it provided support. Again, here the 200-period moving average provided resistance for the market, and that's primarily how they view and utilize these moving averages. Here was a very decisive test of the 200-period moving average, and we came back out. Notice at this period here, that point and this point, how the 50-period moving average, and again this is a daily time frame, provided resistance, but when it penetrated decisively and pushed up. Okay, the only reason I would even bother following these moving averages or these settings, again, there's no magic number. So that quest for the grail, I've been down, and I urge you not to, simply because moving averages are a wonderful tool, but these simple little lines, if they are abused, become like ropes, and they begin to tangle you up mentally and emotionally, and also, more importantly, with your analysis and your trading. The reason I do monitor or keep an eye on these moving averages is not because these are magic numbers or magic settings. I simply keep an eye on these numbers because I know everyone else is. Bottom line. The next set of moving averages, I don't know why that slide keeps showing up, or why that slide keeps showing up. Some other settings which are real popular, if I can find the appropriate slide, is this one. So we have the 500 period moving average, or the 50 and 200, and this is a simple period moving average, and this is for the daily time frame, daily price charts. Now, when it comes to additional other markets, for example, commodities, the 10-period and 40-period moving averages are very popular with regard to commodities. This is sugar, and you can see how the moving average here went up, pushed through, or moderately tested the 40-period, and then reversed sharply to the downside here. And then you can see the crossover over here. A lot of people put a lot of value in the 1040 when it comes to, and what I mean by 1040 is a 10-period simple moving average of the close and a 40-period simple moving average of the open. A lot of commodity traders put a lot of value in this setting. Now, here's another setting which is popular with regard to the weekly time frame, and it's a 13-week, and I like it. I actually do like it. Again, this just gives you a vision. One way to actually think of a moving average is that it's an automatic or an automated trend line, And if any of you have seen my webinar on trend lines, you know how passionate I am about trend lines, because they really indeed are very, very important with regard to market analysis. And as you can see, this is sugar, this is the weekly, and this is a 13-week simple moving average of the close. I think the 13-period or the 13-week simple moving average of the close works equally well in commodities and currencies and stocks. So I actually like this market. And so whenever we start to see weekly closing price action above a 13-period weekly moving average, I think it's a significant event. And from experience, that's what it seems to be. As you can see here, we had a nice cross that led to a very substantial rally. And right about here is when we started seeing closes below. But again, this is the problem with moving averages, is that when their market is not trending, that's when you get a lot of whipsaws in the market. And again, toward the end of the presentation, I'll show you my solution in trying to overcome that. And another popular moving average setting that a lot of people work with is the 13 and 26. This is a 13-week period, simple moving average of the close, and a 26-week. Obviously, where do we get the number 26? It's simply 2 times 13. And for those of you who like Fibonacci, should like the number 13. So, and as you can see here, this is the Johnson & Johnson, and you can play this as a crossover system. Again, here was a nice cross back in 2004, and if you played it on the weekly level, it kept you in for a very nice substantial move from 50 to almost 70. Here was a nice decline, and actually this moving average worked fairly well in a very bad market. And what I mean by bad market is that the market basically bounded or went back and forth between two extremes, essentially 68 and 60. But as far as the crossovers, it seems to have done a very fair job, at least fair, with regard to identifying opportunities within the market. So those are really the popular or the main moving averages that the street looks at, commodity traders and stock traders. With regard to stocks, again, the 50-period and 200-period moving average on the daily chart level is very important to them, to stock traders. The 10-period and 40-period are very popular with commodity traders. I like the 13-week or the 13-period moving average on the weekly level in really all markets. It's a very nice, it's a visual automated trend line. And then the 13 and 26, it's not bad as far as a crossover. But again, I just like to, again, for me and my type of analysis or my style of analysis, I like to keep things simple, and one line is enough for me. Okay. The next section we're going to take a look at, and before I move to, again, I think what I'm going to do tonight, because this information is somewhat intricate, I think what I'm going to do is, following each section, spend about 5 or 10 minutes with questions. So if you have any questions, go ahead and type them in and chat with me, and I'll do my best to answer them, because I don't want to lose anybody's attention span throughout tonight. And I may be halfway through my presentation. I know I still have a lot of material to still cover, especially towards the end. So if any of you okay, here's the question. Could you repeat the commodity 10 and 40 if it was on the close of the open? All the moving averages, well, this is a good question. The question has to do, the price chart I showed of the 10 and 40, was it based off the close or the open? Well, that's what, one of the things that make here's the 1040. That's what makes one of the moving averages so, I think, very exciting. And what I mean by that is these moving averages, or these moving average settings, are set on the close. So the blue line is a 10-period simple moving average of the close. Okay? The black line, let me make that blue. The black line is a 40-period simple moving average of the close as well. Okay. Now what's exciting is that with just a few mouse clicks, depending on the software, the charting software you utilize, you can use the open, and let's see what they look like with the open. These settings right here illustrate the 1040 utilizing the open, not the close. And let me see if I can make it go back to the close. Just a slight difference. You can actually use the high or the low. Or you can actually use the midpoint of the trading range. Again, one of the things I like about moving averages is because it's a tool and a technique, an analytical technique, that you can truly make your own. You don't have to follow, standard, cookie cutter settings that many technical analyst books, recommend. You can actually find a market and a time frame and find the settings you like. You might like to combine, say, a 10-period simple moving average of the mid, combine that with a 40-period simple moving average of the midpoint of the range, or the close, or the open. It's up to you. You have to find what works best for you, and I encourage that in all types of analysis. Any more questions with regard to this section? And again, this section was just simply to show you the settings which are very popular on the street, be it the commodity markets or the stock exchanges. These are what a lot of people look at. Again, I don't think there's a magic moving average number. Like 28 is not the perfect number for moving averages. I follow these moving averages, and that's essentially to kind of get an idea of what other people are looking at or what other people think are important. That's really the only reason I tend to follow these. So let's move on to the next section. I don't see any more questions coming in. And the next section is kind of an exciting section because I'm going to show you something you may or may not have known about moving averages. You can use moving averages to identify Elliott waves. And initially, if you're new to the wave principle, I actually recommend using a moving average. And here's why. Okay, this, just to go ahead and answer the question before it comes up, the blue line you see on your screen is an 8-period simple moving average of the close. That's what this blue line is. Now, whenever you're reading the book by Frost and Prechter, The Wave Principle, you see wave patterns in the book illustrated as line diagrams. For example, this little pattern here, many of you know as a flat correction. 3 waves in wave A, 3 waves in wave B, followed by a move to the downside, an impulse or motive wave in wave C. You've also seen this pattern here too, a motive wave, 5 waves to the upside. Okay, well, whenever you try to make that transition from reviewing the material in the book and then going to your basic price chart, well, your basic price chart is typically, shown in open, high, low, close fashion. And what I mean by that is you have a single price bar, it's a vertical line. To the left, you'll see a small little bar here, and to the right, you'll see a small little bar here. This is your open, right here, that I'm pointing to. That's the open. This is the day's high, or that trading period's high or extreme. That trading period's low, and that trading period's close. So whenever you're making the transition from looking at line diagrams to actually counting Elliott waves on price charts, it can be confusing. And this approach or this technique actually helps you begin to train your eye to developing or unfolding Elliott waves in a market. So moving averages actually can be utilized to identify Elliott waves, and I'm going to prove my case even more thoroughly. Here we have a simple move to the downside in corn. Many of you who have been following my work in futures junctures know that we've been looking for the final fifth wave move to the downside. Considering today's price action, I believe the low's in place, so I'm now looking up $7 a bushel. But I don't want to get off the point here. But as you can see off the high here, we have a clear 5-wave structure, not only basis the open, high, low, close price chart, but also through viewing this move as a moving average. The move to the downside, the move to the upside, and then back down in wave 3, up in wave 4. Notice the slope of the move, very shallow. I say this often, very often with regard to the in futures junctures, that counter-trend price action. One of the key characteristics of counter-trend price action is that it's slow-moving price action. Thus, its slope will be inherently shallow. Then we have a fifth wave to the downside. I may have shown these charts a few weeks ago, but again, here's some very nice Elliott wave patterns which are offered not only by viewing this price chart in open, high, low, close fashion, but again by utilizing the moving average. This moving average, again, is an 8-period simple moving average or average of the close. You can use a 5-period if you would like. You can use an exponential if you would like. It really, again, it doesn't matter. There's no magic number when it comes to moving averages. What matters is that you find something you're comfortable with and that you apply it consistently. If there's any magic to moving averages that I can share with you, that's it. Find what you like, find what works for you, and apply it consistently. But back to the subject. Notice here we have a move to the downside. I'll call wave A. Then we have a 3-wave move up, 1, 2, 3, or ABC for wave B. We have a dip, an advance, another move to the downside, a little sideways move, I'll call wave 4, followed by press down. So this is a 3-wave move, waves A, B, and C. Then we have an advance, followed by another dip down in the moving average, followed by another rally. Again, waves 1, 2, 3, 4, 5. So utilizing the moving average can actually help train your eye to identify the wave patterns which are unfolding in the market. From the previous slide, I identified this move as a 3rd wave advance. Well, if we're going to a smaller time frame, and again, look how clearly the subdivisions of wave 3 come out when, again, still simply utilizing the moving average on a smaller time frame. Waves 1, 2, 1, 2, 3, 4, 5 for 3. And then within wave C, you have a clear down, up, down. So A, B, C. Even if we go to a smaller time frame, here's wave 3, then we have waves A, B, and follow me with the moving average. It basically just comes down very nicely, bounces, comes down very nicely, bounces, and comes down one more time. So we have waves A, B, 1, 2, 3, 4, 5. Now, in real time, I have a different wave count. I was basically calling this 1, 2, 3, 4, and then a 5th wave to the downside for wave C of 4. But again, if you're new to the wave principle and you're having a hard time making that transition from line diagrams that you actually see in the book to applying the wave principle real time to a real time, say, daily open, high, low, close price chart, that transition can be somewhat difficult. And by utilizing the moving average, any moving average, oftentimes it can pull out the wave structure a bit more clearly, or it helps you, again, begins to help you train your eye. Now here's something really cool. Before I get to the really cool part, let me just show you. This is Johnson & Johnson. Again, very simple. From this extreme here back in March, don't look at the open, high, low, close bars behind the chart. Just simply look at the blue moving average. 1, 2, 3, 4, 5. 1, 2, 3. And if you even look closely within this final move to the downside, you'll see 1, 2, 3, 4, 5. To an extent, you may not even actually need the open, high, low, close price chart. The moving average did a wonderful job in actually isolating these waves for you without too much stress on your part. I mean, granted, I've been doing this for 15 years, but again, I remember all too well and very clearly how confused and how frustrated I would get trying to apply the wave principle, looking for these line diagrams on an open, high, low, close chart, and at times it was very frustrating. So one of the things I did early on was kind of come up with a shortcut to help me begin training my eye to look for wave patterns based as an open, high, low, close price chart. Now here's the cool part that not many people are familiar with or know that you can actually do. And let me get everything set up right. Okay, here was the corn chart we looked at a short-term time ago. Okay, now before I start, let me just ask some questions. Okay, with regard to the wave principle, we utilize Fibonacci extensively. As R.N. Elliott said in his book Nature's Law, the Fibonacci sequence is the mathematical basis of the wave principle. It was true then, it's true today, and trust me, in 50 or 100 years it's going to be just as true. So whenever we're looking to identify Fibonacci objectives for third waves, what are some very common wave Fibonacci multiples for the third wave? Of course, if we're looking for third waves, we're looking at the 1.618. 2.618 would be the next most common, and that's going to be followed by 4.236. 4.236 is actually a very formidable objective for third wave rallies. Beyond that, with regard to the Fibonacci sequence, we have next 6.854. These are very common multiples that we primarily look for when we're looking for prices to trying to determine how far wave 3 will move in relationship to wave 1. So these are very common third wave multiples. Now let me ask the next question. Okay, when it comes to fourth waves, what's the most common Fibonacci retracement for a fourth wave? Well, I certainly say it enough with regard to my futures junctures commentary. It's the 382 retracement. We then see sometimes 50% and also 618 when it's very deep. Now, I've mentioned this before, whenever a market is trending very, very hard, the retracement will often be shallow. So typically what I tend to look for whenever I'm examining Fibonacci retracements is primarily focus on the 382. I think that tends to be the magic number right there. Okay, since we know this, let me ask one more question here. How do we determine fifth wave objectives? Well, waves 5 and 1 tend toward equality. That's actually an Elliott wave guideline. Oftentimes you'll see wave 5 equal a 1.618 multiple of wave 1. Or other times you'll see wave 5 equal a 618 multiple of waves 1 through 3. So this is what we know. This is what I write about just about every day in futures junctures, and this is what I teach when I have my seminars. But how does this work with moving averages? Here's the cool part. Here's my Fibonacci extension tool. Now, what I'm going to do, now typically if I'm trying to identify a third wave objective, I would use the most extreme of wave 1 and the extreme, the origin of wave 1 and the extreme of wave 1. Take this measurement and multiply it downward to try and identify a wave 3 objective. Well, let's do that process, but use the moving average, not the actual open and high and low and close. So here's about the extreme of the moving average up here, and then here's the extreme of the moving average to the downside, and then I put the measurement from this extreme. So what I'm actually doing is I'm utilizing the moving average to make my projections. I'm using this extreme in the moving average, this extreme in the moving average, and this extreme. This would be my wave 1 and my wave 2. Now we just spoke and discussed what were common Fibonacci objectives for third waves, and as we know, 4.236 is one of them. Well, look where the moving average actually came to. Here's the 4.236 multiple. So we're actually not utilizing price to obtain these levels. We're actually viewing these multiples, these projections, based off the length of the moving average. Now, we discussed a moment ago what were popular Fibonacci retracements for fourth waves. And we discussed that whenever the trend is down extremely hard, you will often see a very shallow retracement, often 2, 3, 6. Well, as you can see in this slide here, the moving average pushed right up to the 236. We missed it just by a little bit and then began to turn down. Now, here we'll go back, utilize our wave 1 projection, again, basis the moving average, and project that downward from the fourth wave extreme. And as you can see, we came quite clear to very near the 2.618 multiple. Now notice in price, we almost actually achieved that. Now what I'm actually doing here is I'm not utilizing the actual open, high, low, close prices to make these projections. What I'm doing is I'm using the extremes in the moving average. Oftentimes I talk about utilizing Fibonacci clusters in your analysis, utilizing different wave relationships, different wave measurements, and trying to identify as many Fibonacci relationships within a specific area in order to identify a cluster. This is just one more way you can go about utilizing Fibonacci and moving averages, combining it together with the wave principle to identify likely targets for moves and likely reversal points for moves. So this is something unique, I think, that you might have fun playing with. Number one, you can utilize a moving average to identify Elliott waves, but just as you use price moves in determining objectives and retracements, you can do the same thing, but utilizing the moving average. Now, before I have go too much farther into the next section here, and so far we're doing pretty good on time. Okay. Now, while I still have you with me, what I would like to do is, again, stop for a moment and talk about the moving averages, how you can utilize a very simple moving average to identify wave patterns as well as Fibonacci objectives. Does anybody have any questions with regard to this section or this portion, or possibly a question with regard to previous material that I've covered thus far this evening? Okay, here's a question. Could you go back over the fifth wave extensions of waves 1 through 3? Okay, quick question from David. Yes, the moving average that I showed you on corn is simply an 8-period simple moving average. Some of you might like the number 8 because it's a fib number. I like 8. Sometimes I use 5, sometimes I use 8. 6 works. You know, it's nothing magic about 6. Again, there's not a magic number out there. But this just gives you a really good visual representation. Okay, I have a quick question, and I don't want to get off subject too much, but typically what we have, and it's a question regarding Fibonacci projections. Okay, for wave 3. For wave 3, what we typically do is we measure the distance traveled in wave 1, extend that distance from the extreme of wave 2, and the multiples we tend to use for wave 3 are 1.618, 2.618, and I would say 4.236. Now, to a lesser extent, I would say on occasion I do see 2.0. We'll put that off to the side over here. That's very, on occasion I do see it, but it's relevant enough, so I'll include that. For wave 5, typically what we'll see more often than not is wave 5 equals wave 1. That's the number 1, and that has to do with the guideline of wave equality. The next would be 1.618. Depending on the markets and the structures, you sometimes see a 2.618, meaning that wave 5 will equal a 2.618 multiple of wave 1. But we also utilize waves 1 through 3 on occasion to identify fifth waves, especially when the fifth wave is extended, and is often the case in commodities. But what we tend to do is look at 618 times waves 1 through 3. Sometimes I use these multiples a lot in my work. Wave 5 will equal waves 1 through 3. And then the next one would be the same thing, but 1.618. Wave 5 equals a 1.618 multiple times the distance traveled in waves 1 through waves 3. Okay, I believe that answers that question, and I don't want to spend too much more time on that because it's kind of off the moving average subject. Oh, lots of questions. What is the cool software you're using with the Fibonacci objectives? Okay, as far as the software, this is pretty cool software. I love CQG. CQG is a fantastic platform, but it's not the only fantastic platform out there. There's a lot of different platforms, charting software platforms out there that are available for everyone. Trade Navigator by Genesis is an excellent platform, and many of the Fibonacci tools that you've seen me use tonight, as well as in futures junctures and my daily video and my weekly wrap-up videos, are found in the Genesis Trade Navigator software. Also, you'll find these tools available, these Fibonacci tools, in TradeStation, Metastock, NinjaTrader, Supercharts. Fibonacci is very popular within the financial or market analysis community. So most platforms that you examine or utilize will have an application that allows you to do Fibonacci extensions and retracements. Okay, here's a question. Would you consider a sell setup when wave 3 breaches 1, not in price but in moving average? I'm using this chart as an example. This chart, I'm assuming when wave 3, when you consider when wave 3 breaches wave 1. To answer that question, yeah, you certainly could treat. The question has to do with at what point does this application of the moving average with the wave principle become a trade. Now, you could wait for the moving average. Okay, here's the extreme of wave 1 basis the moving average, and here's wave 1 basis the extreme of the actual price. I would say, and the question has to do, at what point would you consider there to be a trade? Would you wait for the wave 1 extreme to be broken, or the moving average to break the extreme of wave 1? Well, as you know, a moving average is a lagging indicator. It's always going to follow price action. By nature, that's what moving averages do. So I don't believe this break of the extreme of wave 1 and the moving average actually occurred until prices were actually trading below. And again, with regard to the application in the current context, I'm simply utilizing the moving average to help train my eye to actual Elliott wave patterns. So what I would prefer to do is begin to examine this price action on a shorter term time frame and begin to examine actual Elliott wave structures and Elliott wave patterns. Again, and this is very important to know, and this is actually probably something you may want to write down as well. Moving averages are a tool. The wave principle is a tool. Oscillators, MACD, stochastics, RSI, technical studies, they are tools. Let me repeat that. Everything I've just described, they are tools. Okay? A tool can be misused. A tool can be helpful. One of the things I speak about in my seminars is I utilize the analogy or the example of a knife. A knife is a tool. A tool in the hands, and that knife in the hands of a skilled surgeon can save lives. That knife in the hands of a maniac can take one. Also, too, another analogy or metaphor I talk about in my seminars is if you have a poorly built house, if you have a house that you just bought and the roof is falling down and the stairs are caving in, whose fault is that? Is it the hammer's fault? Is it the nails, the saw? No, it's the person utilizing the tool. These are tools. And the best way to know and learn how to utilize these tools most effectively is practice. These tools are not magic. They are just what they are. They are tools, and at times they can be very powerful, very dynamic, and they can show you some excellent opportunities in the financial markets. But as a tool, if you do not use them properly, or do not use them well, or do not learn how to use them at all, they can actually hurt you as well. So, okay, next section, my favorite moving average trade setup. And it's very simple, and it's called moving average compression. Okay, this is moving average compression. Notice I have about 6 different moving averages on this price chart. What exactly am I referring to out of all this mess? What exactly am I referring to as far as moving average compression? This is what I'm referring to, this point right here. When all of these moving averages become one, or as I often say, when they become, when they get married. This condition right here is very significant because, as you can see in this slide here, these are the moving averages I'm using: 5, 10, 15, 20, 30, and 40. And again, when I was building my presentation, these were just arbitrary numbers. 5, 10, 15. I've got 5 fingers, 10 fingers total. Again, there's not a magic number out there. But what I'm trying to do is I want each one of these moving average lines to represent a different period of time, from short term to long term. Okay, now what does this do? Why is moving average compression so dynamic? Well, it's dynamic for 2 reasons. The best way or the best example I can explain is if you take a can of, as in the South, we call it Coke. Up north, they may call it pop. I don't know if you can buy cans anymore. Everything seems to be in a plastic bottle. But if you shake it up and then take the top off, it explodes. That's what happens when you experience moving average compression. And the reason why it occurs is essentially at this point you have different classes of investors with different objectives and time frames thinking the same thing. Well, that's a state or a condition in the market that cannot be maintained for any length of time. So what I simply do in a lot of markets is simply wait for this kind of occurrence to occur. Now, if you recall, we were actually working with the July contract. This is soybeans, by the way. And we saw this moving average compression, but you may have recall it as the form, it took the shape of a triangle, a contracting triangle in this market. But again, whenever you see multiple moving averages, and I've got 6, you can use 10. You don't have to use these settings. Again, these settings are just provided as an example to show you the different the mentality, the visual mentality of your short-term investors utilizing the 5-period moving average, and your long-term utilizing the 40-period. Basis trading days, that's 2 months. Okay, so say for example this 40-period moving average represents a trader with a 2-month time frame. Again, so whenever you see all these moving averages come together very, very tightly like this, it typically has a very remarkable result. And as you know, soybeans moved from this area and pushed up to $16 a bushel. Again, there's nothing magic about these settings. It could have been 6, 11, 12, 21, 32, or 31, or 29. But I just wanted to give you an idea of what I'm doing here, what I'm trying to create. I'm trying to start with a very short-term moving average to a very long-term moving average. And I want to wait for these periods of time where you see the market congestion. And we're going to look at some examples because, again, this is my favorite moving average trade setup because I've yet to see this setup occur where all the moving averages come together and not realize a nice significant move, even a modest move. And the cool thing about this is that you can utilize it on any market and on any time frame. This is a very significant and very dynamic moving average trade setup. So let's look at a few markets. I got a stock here, a couple of stocks here. Let me see. Go through some of my charts. Well, I'm the commodity guy here at Elliott Wave, so let's look at a commodity. Here's a great example of moving average compression right here. Notice how all those lines became so tightly bound together right here back in June in coffee, and it led to a very dynamic move to the upside. To a lesser extent, we have the same moving average compression which occurred over here. All the lines came close together, and look at the result of that, again, moving average compression. A very dear friend of mine and a mentor, every now and then you see his name here at Elliott Wave International. His name is Dave Ullman. He's Director of Research. He's taught me a very, very valuable lesson that all you need is one thing that works. And for a long time, what I'm showing you, this moving average compression, was my one thing. It's absolutely dynamite, and it's something to keep your eyes open for. Here's a beautiful example of a moving average compression occurrence which occurred in corn. It led to a very nice move. We went from $6.50 almost to $8 a bushel. Notice again how tightly bound these lines become together. So you're going from a condition of market expansion up here at the top to a point where everything basically blends together, forming one line. That is moving average compression, and that is my favorite moving average trade setup, and it is most often dynamic. Let me show you a few more examples just to make my case. Oh, here's a really nice one. And again, this setup, this moving average trade setup, works on any market and on any time frame. Here's Johnson & Johnson. For some reason, I look at that stock quite a bit. But here's an event back in, this is a monthly price chart. But notice right about here is when you begin to see the transition, where all the moving averages begin to come together. And that was a very dynamic move. Well, of course it was. That was in the early 90s. But what's important, here's Canadian dollar. Here was a very nice moving average compression occurrence that occurred in 96. Now notice too, another reason why I like this setup, notice that this is a monthly price chart, excuse me, and from 1988 to basically now, there's been only one occurrence of this market. One of the big problems a lot of traders have to overcome or learn to overcome, and it can be a very expensive problem to overcome because I've had it myself, is overtrading. Well, this is such a reliable trade setup. If all you can do is demonstrate the patience to wait for this move, wait for this setup to occur, I think you'll be on the right side of the fence more often than not because it slows your trading down. It doesn't occur very often, but when it does, again, it is often very, very dynamic. We've recently seen, let me see, here's a really neat example that's recently occurred in the British pound basis, the weekly scale. Notice right here, we didn't get all the moving averages. The 40 didn't quite get down to where the rest of the moving averages were, but we did have everything from the 30 on down. Again, moving average compression, and look at the result of the move whenever this type of market condition occurs. This is why this market condition is my favorite moving average trade setup. All I have to do is wait for all of these moving averages to come together and form one line, and then I know I've got an opportunity in the making. Now, just to show you something really neat, this is the E-mini S&P. This is primary session. This is a 5-minute price chart. Look what happened. I believe that was Tuesday. Yes, that was Tuesday. All your moving averages came together very, very nicely right here, basically saying that, hey, the market is about to make a nice move, nice big move, and as you can see, we then saw a subsequent sell-off. You can actually even move down to a 1-minute price chart, if I can get the data up. right here. 1 minute price chart. That occurred today at about 1 o'clock. How many of you saw this as a potential trade setup? How many of you were watching the market at 1 o'clock, specifically the E-mini S&P, and realized that, hey, you have an exciting market, event in the E-mini S&P on the 1 minute price chart today at 120. This is a very significant event, and it is going to lead to a very sizable move in price. That's basically what happens when you ever have moving average compression. Again, this is a 1 minute price chart of the E-mini S&P. We just got through looking at this trade setup, moving average compression, in a monthly price chart of the Canadian dollar back in 1996. So I hope I've made my case here, but this moving average compression is dynamic, and all you have to do is be patient, wait for it to form, and when it does form, be ready to act. Okay, I had a question a moment ago with regard to what the averages were, and I believe I may have that slide still around. Again, there's no actual magic to the numbers. I think I lost my slide. But we'll do this. We have 6 moving averages. They were 5 period, 10 period, 15 period, 20, 30, and 40. And again, these are simple period moving averages. I'm not getting fancy. And see, that's another thing about moving averages which are kind of fun. You don't have to get fancy with them. I mean, I could use exponential moving averages here. I could use weighted or smooth or centered or triangulated. You don't have to get real complex with these. Again, I find that the more complex you get with your market analysis, the more vulnerable you make your market analysis. Let me say that one more time. The more complex you make your market analysis, the more vulnerable you make your market analysis. When you're in the trenches, so to speak, you want things very simple and straightforward. You don't want anything really, really complex. But this is my favorite moving average trade setup, and I think I've proved my point with this with regard to the number of the different degrees of scale. More importantly, the number or the different markets we've looked at. Again, this occurred today. Again, this occurred today in the E-mini S&P primary session 1 minute price chart. Here was your moving average compression. It led to a nice little move, nice little pop up. And then here's the Canadian dollar monthly. Back in, I think it was 1996. Yeah, right here. Again, moving average compression. Whenever these moving average lines come together, it denotes the making of a significant and sizable move in the markets. Okay, any questions on this before I move on to, okay, here's a, you guys are kind of getting used to my rhythm for the night. Okay, here's an excellent question. Is 6 time periods the best number to use for finding SMA convergences, compressions? Is the number of SMAs optimal for different markets? Excellent question. And again, there's no magic answer, no magic number. I'm simply using 6. You could use 4. I'll show you in a minute how I basically identify this condition using only 3. I've actually created charts where I've used as many as 15 separate moving averages to identify the moving average setup condition. So it's whatever you feel helps you identify it the most, whatever works for you. I'm just using the number 6 because it seemed like it was pretty, bottom line. Again, there's no magic, and I guess if there's anything I can leave you with, granted I'm not going anywhere right now because I still have another portion of my webinar, but there's not a magic number. There's not a magic way to utilize moving averages that's always right. Again, it's a tool, and as a tool you simply have to find the way that you can best utilize it. And I'm sharing with you a lot of insights tonight that have taken me years to actually develop, and this is a very reliable trade setup. You can utilize moving averages to identify Elliott waves. You can utilize moving averages to make Fibonacci projections and identify Fibonacci retracements. You can use moving averages so many ways. It's actually phenomenal and staggering, because it's, as a single tool, i.e. a simple moving average, it is so versatile. It is unbelievably versatile. Now the next, okay, let me see if I have any more questions here. Ivan, why don't you send me an email and I'll answer that one later. Okay. Okay. With let me see. How would you? Okay. Here's an excellent question from Mr. Kirby. How do you determine your exit point with moving average compression? Okay. With that, I would, as an Elliottician, my answer to that would be to break down or go to the smaller time frame charts, for example, in this instance, and look for the Elliott wave structure. As an Elliottician, of course, I'm going to be looking at Elliott wave structure. But what you could also do to answer that question as far as your exit point, and here we'll utilize the this condition in the Canadian dollar. This happened in '97 here. Okay, you have the moving average compression, basically all your lines. And let me basically point out a very specific market condition right here. This price bar. This price bar right here. Notice how the high and the low of this price bar on that month encompassed all 6 moving averages. Okay? Then we have, now one way you could play this is by identifying this price bar. Excuse me. Let's play, okay, for just as an example, as a, one way to trade moving average compression. You identify this price bar. This price bar, here's the high, here's the low. All 6 moving averages are encompassed by this single price bar. That gives me a definable level here, the low and the high. So as a trader, I'm thinking to myself, I want to see a close above or below the high of that bar before I'm going to take a shot at this market. Well, here's your close right here. This occurred 5-6 months later. Here's your close on this bar right here. Here's your signal to actually sell the market. Okay, so you're going to be, you have the actual close below this bar here. You sell the market on the open. Your stop's going to be the high of the bar, I would suspect. Or what you could do is wait for a break at the low of that bar to actually sell the market. And then what you could do is move to the smaller moving averages either here, which was a 5-period moving average, or the 10-period moving average, and say, okay, hey, that will be my trailing stop, and I'll get out of the market if we see a close above that line. Okay, so if you waited till you had a close above the 5-period, which might be a little quick, then you would have been out, right about here, or on the open, or on the close right here. Or you could use the secondary moving average, in which case you actually enjoyed more of the move, but got out at lower levels. So what I would probably suggest is, this is, again, for an illustrative purposes only, just one way you could actually trade the moving average compression. Simply wait till you identify a bar that actually encompasses all 6 or 10 or 15 moving averages. Play the breakout against the high or the low of the bar that actually encompasses the moving averages, and then move to one of your smaller moving averages here as your as a trailing stop on, say, possibly a close. So that would be one way to handle that situation. And I hope that answers your question.